There's a number that most investors are ignoring. The CBO, the nonpartisan budget analysis arm of the US Congress, just published it. If global temperatures rise along the current trajectory, there is a 5% chance that real GDP in the United States will be at least 21% lower by the year 2100. Not 2%, not 5%, 21%. And this isn't a forecast from an environmental group. This is the CBO, the office that calculates the cost of legislation for Congress. But this isn't a story about natural disasters. This is a story about being blindfolded in front of them. Because when a market can no longer see risk, it doesn't stop trading. It simply goes blind. January 20th, 2025, day one of the second term. Trump signs the executive order to withdraw the U.S. from the Paris Agreement for the second time. But this time, it didn't stop there. NOAA, the National Oceanic and Atmospheric Administration, had 74% of its research budget cut. FEMA was gutted by mass layoffs. And by June, the entire National Climate Assessment was removed from every federal website. No explanation, no redirect. Just gone. To understand why this is financially dangerous, you need to understand one basic rule. A market only prices things correctly when it can see what it's buying. Climate data isn't an environmental issue. It's a risk pricing issue. Banks use it to make loans, insurance companies use it to set premiums, investment funds use it to decide what to buy or sell. When the data is erased, the entire chain doesn't stop. It just keeps running in the dark. Let's zoom into a specific example. NOAA, the Office of Oceanic and Atmospheric Research, doesn't just forecast weather. They maintain databases tracking billion-dollar disaster damages. They run the GFDL models that help Wall Street stress test investment portfolios. When 74% of NOAA's research budget was cut, it wasn't just scientists who lost their jobs. Banks, insurance companies, and pension funds lost the tools they needed to accurately price what they were holding. And here's the transmission chain that most people don't see. Temperature rises, outdoor labor productivity drops, regional income falls, mortgage repayment capacity drops, bad debt rises, banks absorb credit risk. Or sea levels rise, real estate floods, home prices collapse, insurance premiums spike or coverage withdraws, housing market freezes, municipal bonds lose value. This isn't theory. This is mechanism. Now, let's bring in the numbers. The CBO estimates, with a 4-foot sea level rise, residential property worth $930 billion in the U.S. will face recurring flooding. S&P Global calculates, by the 2050s, companies in the global index will face $1.2 trillion in physical damage every year. And the NGFS, the global network of central banks, warns at 3 degrees Celsius of warming, economic losses could reach 30% of global GDP by 2100. Here's the difference. A market with data, like Europe or Japan, can price risk, adjust portfolios, and prepare ahead. A market without data, like the US right now, keeps trading as if risk doesn't exist. And in finance, the most dangerous thing isn't risk. The most dangerous thing is risk you don't know you're holding. So who pays when this bubble bursts? Not the oil companies, not the federal government that gutted FEMA. The people who pay will be homeowners in Florida and California when insurance pulls out, taxpayers when the government has to bail out unpredicted disasters, pension funds when bank and utility stocks drop, and finally, the entire financial system when trillions of dollars of mispriced assets correct all at once. So this isn't a story about climate or politics. This is a story about information and the cost of not having it. When a nation erases risk data, it doesn't save a single dollar. It simply passes the bill to the future with compound interest. And in the world of finance, the only thing worse than losing money is losing money and not knowing why. This is Newsbook Signal. A new signal drops every week. Subscribe so you don't miss it.